Buying and selling crypto has never been this quick and easy, especially on a reputable exchange. This is made possible due to market makers. But what are they exactly? A market maker can be an individual or a financial institution who actively quotes prices on a particular asset by setting bids and asks. However, it's often done by institutions, as they're the ones with enough capital to support large trading volumes. By continuously making offers to both buy and sell an asset at given prices, they help to boost liquidity in financial markets. Liquidity is important as it enables investors to enter or exit positions at their desired prices and size quickly and with ease. Market makers also help promote price stability by maintaining narrow bid-ask spreads, which is the difference between the highest buy offer and the lowest sell offer in a market at any given moment. This is especially true for assets that have lower liquidity, where finding a willing counterparty for a trade can be challenging. In a low liquidity environment, prices experience increased volatility, have larger spreads, and have a higher risk of unfilled orders. This creates a poor trading environment and deters market participation, leading to lower volumes and possibly exacerbating shortage in liquidity. Market makers profit from these activities mainly through the bid-ask spread. As mentioned earlier, the spread is the difference between the buying and selling price for each unit of an asset. For instance, a market maker sets a bid and ask price for 1 BTC at $100 and $101 respectively. If these orders are fulfilled by other market participants, the market maker earns $1. Markets that are more popular tend to have more participants, including more market makers. This leads to stronger competition between market makers, and spreads become narrower. Narrow spreads create favorable trading conditions as orders are more likely to fill, leading to higher trading volume and potentially more profits for market makers. A wider spread could mean more profits for market makers, as traders are charged with a larger difference in price when executing trades. However, if the spread is too wide, it can deter participants, which leads to low volumes and negatively affects the market maker's profits. Besides profiting off of bid-ask spreads, crypto market makers often charge exchanges a fee for their services, which depends on factors such as the exchange's policies and trading volume. Some crypto market makers are also employed by a project's team to bolster the liquidity of their tokens in early stages and periods of low trading volume. As of 2024, notable market makers in the crypto space include Chiron Labs, GSR, Jump Trading, and Wintermute. Each firm would employ different strategies in market making, but in general, use a combination of algorithmic trading, quantitative research, and proprietary technologies. It's also worth noting that market makers in the crypto space have gotten some negative reputation due to the actions of some shady firms. These practices include wash trading, market manipulation, and facilitating pump and dumps. A market maker's role is to promote liquidity and facilitate a healthy trading environment for assets, and unethical practices are of course frowned upon by the industry. Top exchanges in the space have cracked down on such practices by making listing requirements more stringent and delisting tokens that display signs of manipulation. That being said, investors should remain wise by doing thorough research on tokens before investing and sticking to tried and tested exchanges. If you want to learn how to identify wash trading, find out more here.